A previous video in this CFA playlist looked at classic measures of central tendency. This is what's also called the first moment of the distribution or the distribution's location. Where is the distribution centered? And when we say that, I think most of us think of the average or the mean, but we saw that there are more than one definition of the mean, including arithmetic, weighted, geometric, and harmonic. So that naturally leads to what could be called the second moment of the distribution. And just like we also called the first moment the location, the second moment could also be called scale. And these are measures of dispersion. Dispersion is the variability of the distribution around the central tendency. And so this is a classic measure of risk. And just like when we say central tendency or first moment or location, I think most of us think of average or mean. Just like that, when we say dispersion or variability, I think most of us think of volatility, which is easily the most common measure of risk, or dispersion, but we'll see not nearly the only measure. Now, volatility technically tends to mean an annualized standard deviation. And if we square that, we get an annualized variance. So that the difference there are really just units, and we can refer to either the standard deviation, i.e. volatility, as the square root of the variance, or we can refer to the variance, although our volatility is going to be in more natural units for us. So when we look at dispersion, that's variability around the mean, and this is the most common measure of risk. We see that we also, just like we had with measures of central tendency, we have several different possibilities here, some much more popular than others, and some much more technical and less often used. But we have the range, the mean absolute deviation, and then you can see right here, here's a set of the most popular: variance and standard deviation. Standard deviation is the square root of the variance, and by convention, volatility tends to refer to standard deviation, specifically the annualized standard deviation. But you can see here we have both population. We want to distinguish between population variance and standard deviation and sample variance and standard deviation. And then after that, we'll see that although these are the two most popular measures of dispersion and therefore risk, that they have a weakness, and we can overcome the weakness with these so-called measures of downside risk. However, these measures are far less often used, so it would be especially important when using these measures of downside risk to communicate the definition of exactly what we're calculating, because most of our users, even professionals in finance, won't be immediately familiar with how we got to something like semi-variance, semi-deviation, and related measures of downside risk. We'll also look at here Chebyshevs Inequality, which has a marvelous quality, and then coefficient of variance, and finally a Sharpe ratio as easily the most common measure of risk-adjusted return, or return per unit of risk. And so in terms of measure of dispersion, this first most basic one is a range. The range is just the difference between the maximum and the minimum value. So here we have hypothetical returns for, you can see, 1, 2, 3, 4, 5 years. And the range is simply the difference between the maximum value, that would be 29.67, minus the minimum value, that would be negative 24.33. And the difference between those, if we take 29.67, which I've blocked out, 29.67 minus negative 24.33%, we get the range of 54.00%, where we've just illustrated the ease of computation as the advantage. The disadvantage is that it doesn't tell us anything about the distribution of the data or the shape of that distribution. The interquartile range, IQR, is the difference between the third and first quartile. You can see defined here. Third quartile minus the first quartile. So it's the length of the interval containing the middle 50% of the data. The larger this interquartile range, we'd say, the greater the dispersion. And you can see because it's the difference between the third and the first quartile, it would obviously encompass or include the median, which is the second quartile. And so here, in a very simple example of only 4 annual returns, if we computed just the first quartile, it's a negative 11.28%. So in terms of a sort, that's falling somewhere in here. And the third quartile, 15.3%, is following somewhere between here. And we're getting the difference between them here as the interquartile range as a measure of dispersion, in this case equaling 26.58%. Next, we have the mean absolute deviation. And you can see abbreviated MAD, we have the sum of here in the numerator, we have the difference between each observation and the mean, but the key here is it's the absolute value. So all of those differences are positive or absolute values, and then we're dividing by the n. So we're taking an average, but it's an average that's always an absolute value. So here, for this hypothetical data set, we have 1, 2, 3, 4, 5 data points. I'm not showing the mean here. Didn't show up on the slide. I've got it on my own sidebar here. And the mean here for a sample average, I'm just going to denote that up here. The mean here happens to be 4.60%. And so what then we've got is, for the mean absolute deviation, we've got this return here, negative 24.33% minus 4.6%. And then that is obviously a negative number, but we're taking the absolute value of it. And we're doing the same here. Absolute value of 29.67 minus 4.6% as the average, taking the absolute value. So for each of these values, we're getting the difference or distance from the mean of 4.6%, but the negatives become positives. So greater distance negative is still a greater distance. We're adding those up, and then we're dividing by 5 to get 16.21%. Advantages: it uses all of the observations and is superior to the range as a dispersion measure. Disadvantage: difficult to manipulate mathematically. What that means is not so difficult to calculate, like we were just on our way to doing, but difficult to use it in a calculation, like when we look at the standard deviation. That's very amenable to calculations if we want to use it in portfolio variance calculation in the mean variance framework. I've actually never seen the mean absolute deviation used in a calculation, only expressed as a statistic on its own. Okay, then next we have the most popular measures, variance and standard deviation. And so here is our population variance, and I mentioned in the previous video just about notation that when we talk about the population, by convention we use Greek symbols. Greek symbols are a sort of telltale sign that it's a population parameter. And so for that reason, Greek sigma. Greek sigma is by convention, and it's almost always used for the standard deviation by itself. When squared, it's the population variance, but it's no accident that we're using a Greek sigma for the population parameter that is the variance. And so I think the population variance has a very straightforward sort of English definition. So although the formula may look like a mouthful, it's actually not. It is, the population variance is the average squared deviation. See how easy that is? To me, it's a 3-word definition. Average squared deviation. Each observation, we take each observation, square it from here. Notice mu is the population mean, again, a Greek symbol. So we have here a deviation of the observation from the population mean. Notice the observation has a subscript. So we're going through every observation, but the population mean doesn't need a subscript. There's only one population. So each of them is subtracting the same each different observation from 1 to n is subtracting the same population mean. That's the deviation. Squaring that deviation. So here is our sum of squared deviations, and then we are subtracting by the number of observations. That's why I say it's the average squared deviation. That's the variance. Its units are in squared units, hence the number itself is generally not intuitive, and we say take the square root of it, same formula, to get the population standard deviation denoted by sigma that is in the convenient units. And notice the denominator is a straight up n. There's not an n minus 1 here because this is a population. We're not actually computing a sample statistic here. This assumes with population that we have all the observations or all the elements in the set that constitutes the population. Here is just a hypothetical calculation where of several fund values and their portfolio turnover with the mean population variance, and then the square root of that is the population standard deviation. I won't go through the calculation here on that. Okay, then now here's the more realistic use case. We just looked at population, and in practice we generally, in most cases, we don't have the population. In most cases, what we really have is a sample. That includes, for example, if we just go back and measure, for example, a portfolio's or a fund's returns over the last, let's say, 1, 2, 3, even 5 years, that generally is a sample. It's not the full population of the fund's theoretical returns. Even a historical window is generally a sample, and it's just an illustration of why specifically, in most realistic use cases, we're talking about a sample variance and a sample standard deviation. And you'll notice, as betrayed by our notation, we switched from Greek sigma to Roman S squared to denote variance and S to denote the sample statistic that is a sample standard deviation. And notice here, we switched from what was the population parameter denoted by Greek mu to the Roman X with a bar above it to note the average sample mean. But so here we also have n observations, but in this case they're the sample, not the whole population. So we only have one sample mean for each sample that we take. But although it will itself be a random variable because we can go back and get different samples, but we do have a number of observations from 1 to n. So the numerator here, although the notation has changed to denote that we are now talking about sample instead of population, the numerator is the same. It's the deviation squared. And so for that reason, I say here the English definition is almost as easy. Remember, with the population variance, I said the definition was it's the average squared deviation. Here I just say it's the almost average squared deviation because we're taking the sum of these squared deviations, and instead of dividing by n, we're dividing by n minus 1. That's the big difference. And if you worked with variance before, you've probably seen this before because when you first encounter it, there's a lot of questions as to why is this n minus 1 versus n. And very briefly, I will just say, because you can go to our forum if you'd like to take a deeper dive on that, where we've got all the theory and such. But I will just say briefly that it's not wrong to divide by n. We're talking about here sample statistics, right? Sample statistics themselves are random variables. And so they are estimates of population parameters. The estimates have certain properties. It's not necessarily wrong to generate a different estimate with a different estimator. We could divide by n. And in fact, that would be called a MLE, or maximum likely estimate. It's just actually less common. If we want an unbiased estimate of the population parameter, that is the population variance, then the estimator with the most desirable properties, including the unbiased property, divides here by n-1. That's all I'll say about that. And so if you have struggled at all with before the question of what's the technically correct way to calculate the sample variance, I would suggest to you that it's probably the unbiased estimate or unbiased estimator. The estimator is the recipe that generates the estimate, the number. It's probably the unbiased version, and therefore it's this version that we're showing here, the n-1. So it's no accident that that's what the CFA is showing. I'll put that one more way, and that is to say that I don't think you could ever be wrong. If you just divide it by n here for the sample, then the thing is you're open to that criticism that that's not your unbiased sample variance. You should be using n-1. But if you use n-1, it's very hard to criticize you. I'll say for one more reason, and that is that you'll notice when you use n-1, that smaller number, this is going to be larger. And so as a sample statistic, larger here would be more conservative, right? So when we use minus n-1, we really have two arguments. First, it's the unbiased sample statistic, and also it's the more conservative. Can't beat that as an argument. Taking the square root of that gets us the sample standard deviation. Okay. And then similarly here, I have an exhibit. Not going to go through the calculations here because you have plenty of other resources for that. And feel free to go to the forum. We'll share the Excel spreadsheet, of course. But we have sample variance, take the square root of that, gets us the sample standard deviation. And you can see here we have a case of noticing that the sample variance, these are in units squared, they're just not intuitive. So that's where we get, that leads us to these other measures of downside risk, which overcome the weakness, which I don't think I actually mentioned in retrospect. But the weakness of the sample variance and sample standard deviation is that they count upside movements the same as they count downside movements, right? And if we're using these for measures of risk, if we think about it, if we just imagine, let's just say a stock, okay? So if I think about my portfolio and a stock that starts here at time 0, if we have the stock, and I'm just making this up, if we have a stock that just does something like this, it jumps around, but mostly it's upside movement, that could have high volatility because, right, when we do that sample standard deviation, sample variance, we're squaring the difference here on the, so that means negatives get treated the same as positives. So a stock like this could actually have the same volatility as a stock that's something like this. Bottom line on those measures, that classic measure of sample standard deviation is it doesn't care if the volatility is due to up jumps as opposed to down jumps. But in risk, of course, we really only care about the downside movements or the drops in the stock. So that's the rationale behind these downside risk measures. Less popular because maybe they're a little more technical, maybe a little more less intuitive. But here we have semi-variance, which is the average squared deviation below the mean. And so we actually have a similar calculation here that before, but you'll notice we actually have a condition with the sample variance, where we're taking an almost average squared deviation, all of the observations, the difference between the observation and the sample mean. With the semi-variance, we're only summing the observations. The key here is this condition. We're only including here in that numerator the observations that fall below the sample mean. Put another way, observations that fall above the sample mean are excluded, and in effect, they're not penalizing us with a higher semi-variance. So that's a very elegant logic. I hope you would agree with me. So just to illustrate how that would work, here we have an example, 1, 2, 3, 4, 5 years. Here we have 5 hypothetical returns. And then the mean, again, is positive 4.6%. So if we just went to calculate a regular sample variance, right, we would take the difference between each observation and the mean, including, for example, this second observation, 29.67. That's a very high number. It's quite a bit above the 4.6. So in a regular sample variance, this 29.67 minus the 4.6, this would contribute significantly to the sample variance. But it's a positive 29.67. The semi-variance doesn't think it counts, basically, toward this measure. So the only observations that count are that per that condition, the ones that fall below the 4.6. And in this case, that happens to be, well, this return is below the mean, and this return is below the mean. We have 5 means, but only 2 of them are counting. So we're really in this numerator only taking the negative 24.33%. I'm going to leave the percent off, minus 4.6. I'm going to leave that out. We're taking that difference and squaring it, and we're skipping this one per that condition, and adding here negative 6.98% minus 4.6%, squaring that, and then we're done in the numerator. What are we using in the denominator? Well, importantly, we're not just using the 2, because that wouldn't be fair to the spirit of this. We're using all 5, which lowers this number, right? We're including all the observations mean. The more observations relative to the ones that were included means the more above mean outcomes we have. So hopefully that logic is intuitive to you, that we want to include all of them are really n minus 1. So in the bottom here we have 5 minus 1 as the denominator. So you see the only difference here really is that we still squared deviations, but we only included the 2 that fall below the mean, and that, in this case, brings the semi-variance down, and as the square root of it, the semi-deviation down to 15.58%. The target semi-variance, only difference here is we switched, right, before we had the sample mean that was 4.6%, so that's computed from the sample. Here, instead of the 4.6, we select a target return. That's why here we've got 11%, so we could dial this up if we wanted to, but otherwise the same calculation applies. Chebyshevs Inequality says that for any distribution with a finite variance, the proportion of observations within k-standard deviations of the arithmetic mean is at least 1 minus 1 divided by k squared for all k greater than 1. So that means, for example, if k equals 2, we have here 75% is equal to 1 minus 1 over 2 squared. 2 standard deviations is 1 equals 1 minus 1/4 equals 75%. In other words, at least 75% of observations are within 2 standard deviations about the sample mean, or put another way, no more than 25% are greater than 2 standard deviations or outside that region. Well, what is important about this? What's important about this is right here. The reason this is used is that in practice, oftentimes, it's not such a clean academic mathematical world. We don't know the distribution. We don't know it. We're just making an assumption. The magical quality of Chebyshevs Inequality is that we can use this as an approximator for any distribution with a finite variance. We also have, as measured dispersion, coefficient of variation. This is the ratio of standard deviation to their mean value. So sample standard deviation, notice. For a second there, honestly, I sort of forgot. Population sample, and then I just had to look, and I see, oh, it's an S. It's an S, not a sigma, so it's sample standard deviation. And I'm dividing the sample standard deviation by the sample mean. So I'm just rescaling the sample standard deviation into something that's more comparable maybe. So this allows direct comparison of dispersion across different data sets and is a scale-free measure. Here's an example of that. Sales in 4 different companies here in millions, 850, 900, 973, 824. The mean of that is 886.75. And then we would compute a sample standard deviation. So that if we just told somebody the sample standard deviation was 65.58, the point is that high or low? And really, in isolation, it's really impossible to say because it's not really scaled. So, but if we divide it by the sample mean, then we've got a coefficient of variation, which actually on its own does lend itself to some interpretation. It's scaling the standard deviation for us. The Sharpe ratio, well, I think I mentioned at the beginning that this is definitely one of the most popular measures of risk-adjusted return. I said it that way because we have in the numerator a measure of return, or specifically excess return, because the portfolio return minus the risk-free rate, excess return, usually connotes in excess of the risk-free rate. So we've got an excess return, but we're dividing it by so you can see here, sample standard deviation. So we've got a measure here, by no means the only measure, but arguably the most popular measure of return over risk, right? So often we want to do this. A return is generated, but the return by itself could have been earned by taking on massive risk, or maybe by very little risk. So often it's natural to want to put that return in context by risk adjusting it, or put another way, return per unit of risk. And now, while there may be a limited number of measures of return, of course, we've already seen there are many measures of risk. In this case, we're using the most popular one, sample standard deviation. That's our Sharpe ratio. In English, we could say excess return, because it's important to subtract the risk-free rate in our Sharpe ratio. That's the word excess, divided by sample standard deviation. So this measures the reward per unit of risk. And the key limitation there is the fact that it uses only one aspect of risk, the most popular, the standard deviation. And what might be an argument against that specifically? We've already mentioned it. Well, it's the fact that this popular measure of standard deviation, and therefore the Sharpe ratio, is going to include positive jumps against it, so to speak, in a way. It's not only downside risk. In other words, it's a mixture of what we could call good and bad risk, or that is indifferent to the variability, of the direction of the variability. Here's just an example of calculating the Sharpe ratio with 2 different funds. We've got arithmetic mean, standard deviation, risk-free rate. The Sharpe ratio here, 0.39. You probably can figure this out. The 0.39 should be equal to our excess return in the numerator, that's 7.8 minus 1.8, divided by our standard deviation in the denominator, 15.56. And that's a 0.4. And in my experience, that's a pretty good, not necessarily great, but pretty good Sharpe ratio. Then we have symmetry and skewness in the return distribution. So of course you've heard of the normal distribution. It's used extensively in financial risk management. And I would note it's also justified by the central limit theorem. So it's not just by nature of voodoo that we're using the normal. And it's not that we should always dismiss the normal just because it's so simple. The central limit theorem, if the assumptions are valid, justifies the use of a normal distribution. So it rightfully has a central place, so to speak, in financial risk management, if you ask me. But we have this popular rule of thumb, if we don't have easy access to the calculator, 68.3%, or just over 2/3 of the observations of our normal distribution, lie within one standard deviation, plus or minus 1 sigma. 95.5% of the observations lie within 2 standard deviations, and 99.7% of the observations lie within plus or minus 3 sigma. So you can see for a normal distribution, when we get out to 3 sigma, we're getting pretty close to the 0 axis here, and we have 99.7% of those observations are within 3 sigma. For this reason, you'll see things like when a 4 sigma event occurs in the markets, that is to say, when there's a drop or change that 4 standard deviations, that is considered an extremely rare event, and basically it indicates probably that the normal distribution wasn't appropriate in the first place. I have here a standard normal distribution, which is a special class of the normal, where we've said the mean is 0 and the variance is 1. So that's a unit normal distribution. That term here, we add that to the normal distribution standard. We tack that on to signify that we have mean of 0 and variance of 1. And by the way, if I could say variance, or probably should say, it's more typical to denote this mu, the sigma squared. But so I forgot the sigma squared, but it wasn't deadly because for the standard normal, both the variance and the standard deviation are both 1. 1 squared is 1. So not deadly, although I should have said squared there, because that's usually how we signify with the variance. But this is the standard normal distribution, and notice the normal distribution really only has 2 parameters. The first and second moment, the mean and the variance. If I say to you we have a standard normal distribution, by definition that I've just told you that standard means mean of 0, variance of 1. That means that if I say standard normal distribution, I have fully specified the distribution. I don't need to provide any more information. Standard already tells you what the 2 parameters are. They're 0 and 1. I don't need to tell that fully specifies it. That's a fully specified distribution. So standard normal distribution is kind of a cool distribution because we don't need to say anything else. It's fully specified, and we can go and use the lookup table in the back of the statistics without any other information. That's not like any other distribution. If I say standard T to students T distribution, for example, well, I haven't told you the degrees of freedom. So you don't have enough to specify the distribution. But standard normal distribution fully specified. By definition, its skewness is 0, so it doesn't lean either way. And importantly, from risk management perspective, the kurtosis of a normal distribution and a standard normal distribution is 3. That means excess kurtosis, which is simply kurtosis minus 3. It just rescales it. The excess kurtosis is always 0 on a normal and therefore a standard normal distribution. So that skew and kurtosis are important because these are measures of the third and fourth moment. So skewness refers to the asymmetry of the distribution. So here's the formula in the CFA syllabus. And they've chosen to go very specific here. Well, you might ask, why so many dangling elements here? Well, it's very simple. This is just a sample skew. So, and no accident really, because we see that Roman numeral to sort of betray the fact that this is a sample statistic. And the CFA has been careful to be very specific or precise about the sample statistic. So this is the skew that, for example, you should get in Excel and in the appropriate software when they're correctly making the adjustment here for a sample. That's all this is. Notice this is just an adjustment here for sample skew. What we really have here is a sample variation on the third, let's say the third moment about the mean that is standardized by the cube of the sample standard deviation. So we really do have, we know that the sample mean or measure central tendency is first moment, and then we have the variance. That's the second moment. Now we're at skewness, And then we can talk about the third moment, about the mean, which is really just a numerator. And that third moment about the mean being a cubed quantity is then rescaled or standardized by dividing by the standard deviation, sample standard deviation cubed. And quick sidebar, if that looks confusing, why this adjustment is n over almost n squared, well, that's because this is a sum of cubed quantities. So this is very large. And if you think about just borrowing, let's just borrow one of these, taking this and dividing it by one of these almost n's, then we're getting more like an expected cubed deviation, which then itself is standardized by dividing by the cubed quantity. And the adjustment over here is really more like an n divided by just one of these. So we have two of almost n, which really looks more like an n minus n squared here, which I admit looks confusing. That adjustment wouldn't be so dramatic, but that's because one of these in the denominator is really needed over here to take this very large quantity and make it look more like an expected third moment in the numerator. Okay, that's a technical sidebar. The point here, though, is really we don't have the third moment itself. We have a function of the third moment. That is the third moment standardized by dividing by the s cubed. And then we have an adjustment here to acknowledge this is a sample. And in terms of the skewness, positively skewed, we say positive or right skewed. That is more outliers in the right tail. And as a general rule, you may be aware that this is actually not a universal rule. There are exceptions to this, but in practice it works pretty well. For a positive skew, the mean is greater than the mode the mean is greater than the median is greater than the mode. Negatively or left skewed is illustrated here. We have many outliers in the left tail, and in this case, directionally, it's the opposite. Mode tends to be greater than median, tends to be greater than mean. Here's an example, and I won't go through the calculations of this for skewness, except to say that we do need, for this several years, we have returns on a fund. N is 10. Here is our average return. It's 10.03. And a key step here in calculating the skewness is to take the difference between the return and the mean return, right, for each row. Mean return observation minus mean return. That deviation cubed gets us this very large value. The sum of all of those very large cubed deviation, here it is right here. And then the sum of these cubed deviations, negative 34, 552.04, that'll be divided by the sample standard deviation cubed, 4,043, and then that's going to be multiplied by n, which is 10 over n minus 1, 9 times 8, right? So that's that adjustment factor there, and that'll get us to the skewness. In this case, negative 1.19, negative number implying that the distribution is skewed to the left or has a, let's say, slight negative skew. Kurtosis is extremely important in distributions. This measures the heaviness of the tail. So that's how I like to think of it. Some would call kurtosis a measure of the fatness or lightness of the tail. I prefer density of the tail, or is it heavy or light? So the normal distribution is sort of the benchmark. And that's where the kurtosis equals 3. Recall that's the same as saying excess kurtosis equals 0. So if we have normally weighted tails, and this is a property of the tails, we could say that's mesokurtic. thinner tails than normal, that is when the kurtosis is less than 3, and I would prefer to say they're lighter tails, then we have platykurtic, term that I rarely see, and that's because, at least in financial risk, the most popular term here and what's of concern to us is when the tails are heavier than normal, they have greater density than normal, kurtosis is greater than 3, it's the same as saying excess kurtosis is greater than 0, and we would say that the distribution is leptokurtic, or it exhibits leptokurtosis. Would also say that, so in general, if I were to draw a leptokurtotic distribution, a good candidate of that would be a student's T distribution. Student's T distribution has slightly heavier tails than normal distribution, and let's say with fewer degrees of freedom, so that I had heavier tails, then I would get here a distribution that is more peaked than the normal, but would have heavier tails. And I'm not doing a great job of it, but my only point here is to show that if we think about the distribution, I'll try again. I'm going to go for a greater peak, and then I'm going to come inside and then go for a heavier tail, higher peak, and heavier tail. If we think about the distribution as having a tail, a shoulder, and a head, then in general, leptokurtotic distributions have higher peakedness, and so that density is sort of taking away from distribution in the shoulder. You can density in the shoulder, and they would necessarily have greater density in the tails. So higher peakedness, you see this a lot. We've had a lot of conversation on our forum about this. It definitely associates with leptokurtic distributions, higher peakedness, but as many will rightly say, there are exceptions to the rule. So a higher peakedness is not the essential characteristic of a heavier fat-tailed distribution. The essential feature of a heavy-tailed distribution is that we have greater density in the tails. And you think about it, this is appropriate as the measure of risk. We're not really so much concerned about the peaked here. If we have a heavy-tailed distribution, what we care about is the fact that that means, you can see visually, we have a greater probability of outcomes that are in the extreme tails. And specifically on the one end where there's losses, that's where we're concerned. We're concerned about tail density. It's appropriate that that's the essential feature. Yes, it's also, by the way, true that it's associated by nature of the fact that the density is extra here, less here, so higher peakedness. It's also a fact that in most cases, this distribution will also be more peaked. So we have here an analogous formula for the kurtosis where now, unfortunately, we have more adjustments, so to speak, although again, we don't need to get bogged down in the adjustments because we continue the pattern. The central tendency first moment, the mean is, that's measure location. Second moment is measure of scale or variability. That's our variance, and its square root, our standard deviation. Third moment, then we saw a function of the third moment was the skew, where that's the expected third moment around about the mean, then standardized by dividing by the cube of the square root. We just continue on here where our essential relationship is here. We have in the numerator what's getting at an expected fourth moment about the mean, although it's not divided by the n, so we've got a very large quantity. Observations raised to the the deviations raised to the fourth power, which then needs to be divided by the standard deviation raised to the fourth power, which is obviously equal to the sample variance squared. When calculating it, it's almost easier to think about that as a sample variance squared. But in any case, then we've got a lot of adjustments in there that the CFA has accurately made this calculation accurate and precise because it's a sample, but we still continue the same pattern. What we have here for the kurtosis is effectively we have an expected fourth moment about the mean that is rescaled or standardized by dividing by the standard deviation raised to the fourth power. And so here, again, won't go through the calculations in specific, except just to say that we continue the pattern. We still do have a sample mean here. This really means to be an R with a bar above it. And this column here generating very large numbers because it's each return. It's the deviation of each return from its sample mean, but that deviation is raised to the fourth power, very large numbers, and summed, which then needs to be fed in, right? That summation is right here, this numerator, then needs to be standardized by dividing by s to the fourth power, and then basically some adjustments to calculate our kurtosis, 5.76. That's greater than 3. If we subtract 3, you'll notice it's not exactly subtracting 3. Why is that? Well, that's all those adjustments, right? If it were a population kurtosis, the -3 would get us exactly to the excess kurtosis. But we have these adjustments so that it's not exactly 3, but you can see it's not greatly off of that. But our excess kurtosis, it is consistent with an excess kurtosis greater than 0. And so we could say this is a leptokurtic distribution, and it has, therefore, heavier tails than the normal. What does that even mean? Well, that just means that relative to the normal, where we saw that, for example, outcomes greater than 3 sigma are extremely low probability, less than 0.3%. Well, this distribution mean leptokurtic means that there's a greater probability of those extreme outcomes is how I would look at that. And then finally here for this portion, we have geometric and arithmetic mean, which is illustrated and goes back to concepts that we saw in the video on mean. But here we take an example of a 2-period, this is a binomial tree. The $100, notice, can jump up, can double the 200, or can get cut in half to 50. And then in the next step, that's also true, right? We have a 2-period binomial here. So if it jumps up to 200, then the 200 can also double, but can also get cut in half. This is recombining because the doubling to 200 and then half back to 100 gets us to the same destination as if we cut to a half to 50 and then doubled back to 100. And then what's interesting about this is that the geometric mean is so much different than the arithmetic mean. Our geometric mean, our 2-period geometric mean here is a function of the 4 values we have at the terminal. And just note that we actually have 4 distinct outcomes here because there's 2 paths to getting to this 100. So there's really 2 100s here in the middle, right? Because we can get here up, then down, down, then up over the 2 periods. So for the geometric mean, we have 400 multiplied by 100 multiplied by 100 multiplied by 25. That product raised to the 1/4 equals the 100. And then for the arithmetic mean, we have 400 plus 100 plus 100 plus 25. So a summation instead of a product. And we're dividing that by 4, arithmetic mean, typical arithmetic mean. But that equals 156. Different. And the geometric mean is 0. The geometric mean return is 0, which is less than, and will always be less than, the arithmetic mean return of 25%. The arithmetic mean return is the one, that's right here, is the 156. divided, that's my 156 calculated here, divided by 100. That ratio raised to the 1/2 or the square root because we have 2 periods, and then I subtract 1. And so that equals 25% as the arithmetic mean return. And so the arithmetic mean return will be greater than the geometric mean return as a function of the volatility. And that leads to our interpretation that the geometric mean is appropriate for making investment statements about past performance, but the arithmetic mean is more appropriate for making forward-looking investment statements. So that's the important takeaway here, that when we're talking about forward-looking investment statements or expectations, the arithmetic mean is probably more important. And that concludes this section on the CFA syllabus that was really largely about these functions of the second moment, or really dispersion as a measure of a variability, including but not limited to variance and standard deviation. And in that, in turn, we distinguish between sample and population, but we also looked at other measures of dispersion. And if that video is helpful, make sure that you subscribe to the channel so you get notified of my next video. Thank you very much.